and welcome to this week's look at the major news stories that have affected the market so far and may well rumble on. Today we're going to take a look at a generalised view of inflation and what's happening with central banks, particularly in Europe. We're going to take a look at the euro dollar and the dollar against the Swiss franc, what's been going on with those couple of pairs this week. The S&P 500 we're also going to cover. The chart's not looking so great for that, and we could be teetering on the edge of a bit of a fall. And we're going to finish off with what's happening with the oil price and why it's driving the way it is. So, to start, inflation is still dogging the economy, particularly in European nations. And what are the central banks doing or have been doing? We're going to take a quick overview of what's happened and what's been said in the last week or so. So, as I said, inflation is still gripping European economies, much more so than the US, for example. But September saw a shift in tone from the European central banks. Some paused, as some appeared to be approaching their peak rates. The focus now is on how long will these rates remain steady and potentially high. Well, the recent surge in oil prices, which we will come on to later, has complicated what is already a difficult balancing situation. The potential here to fuel inflation in terms of the rising prices of oil, and they also exert downward pressure on economic growth, the sort of double-edged scenario that nobody really wants. So, what have the ECB been up to? Well, they increased the base rate by 25 basis points on September the 14th. Some economists are saying that was a dovish hike. Now, what have they been saying? As always with these types of economic announcements, what is said is also as important as the actual number. Well, they've acknowledged the potential for rates to have peaked, but said they need to maintain rates at a restrictive level for as long as necessary. If you look at sort of some growth figures, Central European bank figures, we're talking growth of 0.7% this year and maybe 1% growth next year, which doesn't compare particularly favourably with the US, for example, where it's nearly 2% in 2023. What about the Bank of England? Well, the Bank of England this month paused after 14 consecutive hikes. The lower figure than expected for inflation August may well have contributed towards that. But Bank of England Governor Andrew Bailey basically said that they need to closely monitor the need for further hikes. Now, a lot of economists are suggesting this is the peak for the UK interest rate, and many consumers will hope so. But like the US Fed and many other central banks, the Bank of England are definitely trying to convey the high for long narrative. There are analysts over here in the UK that are saying that we may well see rate cuts towards the late part of 2024, but that seems a long way off at the moment. We'll finish off with the Swiss National Bank. They paused for the first time since March 2022. However, they did say the war against inflation is not over, and they may well consider further tightening in December. Now, that was obviously one that's labelled as hawkish. So, again, there's not a lot of clarity out there. We do appear, based on opinion, to be approaching the highs, the peaks for most countries, but obviously they all retain the rights, and with oil price and other factors coming into play, we could see inflation creep back up a little bit more. Now we're going to take a look at a couple of currency pairs involving the US dollar, which has been performing quite well recently. The euro against the US dollar takes a hit, whilst dollar against the Swiss franc surges. A couple of main points to take away, if you like. The euro struggled to clear the 1.0670 resistance and declined versus the dollar. And we're seeing the formation of a major bearish trend line with resistance at 1.0585. Now, if we take a look on the hourly chart, we see a move below the 50-hour SMA and 1.0600. The bears then push the pair below 1.0585 pivot level. Now, the first major resistance being encountered was around the 50% Fibonacci retracement level and 1.0615. An upside break here may well send it back to 1.0670 resistance level, and past here maybe even as far as 1.0720. However, immediate support may well be found at 1.0555, but that could decrease to 1.0540, and a downwards break of spot 540 could well lead to us going as far down as 1.05 itself. So an interesting time and a little bit of volatility out there. And the dollar against the Swiss franc, well, we've been seeing it's been gaining pace, if you like, above 0.9135 resistance zone as a key bullish trend line forming with support near 0.9150 on the hourly chart. We see that the bulls pump the pair above the 50-hour simple moving average here and 0.9135. A high formed 0.9174, and it was showing some more signs of an upside movement there. We are looking for resistance around the spot 9175 level, then spot 9200 and spot 9220. A break above here and an RSI climbing to above 80, we could well see a test of 0.9300. Now, if there's a downside correction, there's immediate support near the key bullish trend line at 0.9150. And if a break through spot 9135, where we're looking at the sort of the 50-hour simplified moving average and the 23.6% Fibonacci retracement, that may well spark bearish moves. And we look at the next support then at spot 9080. That goes, then we're looking down to spot 9010. GDP data due out Thursday, late Thursday UK time. It may well have an impact, so keep your eyes on that. I think we're certainly going to see some volatility, so don't forget your risk management techniques. Now we're going to take a look at the S&P 500 and a chart on that. The price does seem to have reached the edge of a bit of an abyss. Now, what are the current reasons for concern? Well, there seems to be more and more chance of a shutdown of government agencies in the US. Maybe as soon as next week, as the new fiscal year starts on the 1st of October, if they can't get these budgets agreed. We've also got the prospect of long-lasting high policy rates hitting hard. The S&P 500 has been in decline since last Wednesday's Fed meeting. The thoughts of interest rates staying as high as they are for a very long time, clearly having an impact. Now, according to MarketWatch, the fear index, which is made up of a number of inputs, including the volatility index, for example, reached the extreme fear level for the first time since March the 15th. And that was the banking crisis when we had the run on the US banks and a couple of them obviously going under. If we take a look at the weekly chart of the S&P 500, we've got a logarithmic price scale. Now, the price is forming a long-term channel that takes into account the beginning, that's number one, the bottom, number two, of the coronavirus pandemic, the historical maximum, number three, the bottom of 2022, that's labelled 4, and the high of 23, that's labelled 5. And the price has approached and is pretty much there on the lower border of the channel. Now, that could be regarded as bullish. Support from the lower border was seen in March of this year. We go back, to the banking crisis, etc. So it could be a bit of a bullish sign. On the other hand, if the negative scenarios that we're talking about here do come to fruition, so we're talking, the shutdown of government agencies and increased inflation, we've got oil sort of pushing pressure on that figure at the moment, and a decrease in the labour market, then the fall into the abyss, slightly dramatic maybe, may well come true. We've already mentioned US GDP data in terms of the US dollar currency pairs, but certainly that may well cause some more spikes in volatility and some movements for the S&P 500. So again, don't forget those risk management techniques. Okay, finally, we're going to take a look at oil a little bit closer. We've already mentioned it a couple of times in terms of inflationary pressure and how the price has been going up. In fact, it surged to a new high of the year. Let's take a look at the chart. That shows on Tuesday, a barrel of WTI cost $87.87. But by Thursday morning, the price had exceeded $93 a barrel. That's an increase of over 6% in just 2 days. The main drive for this still remains the voluntary reduction in oil production by the OPEC plus countries. They obviously want higher prices. But added to this was a reaction on Wednesday to the oil inventories and oil reserve figures in the US. Inventories were expected to go down by 0.7 million barrels. They actually went down by minus 2.2 million, so quite a significant difference. In fact, Reuters, for example, are reporting that inventories are approaching historic lows in the US. Now, clearly the US is trying to reduce the oil price, or at least the effect of the decrease in production by releasing their reserves, but the chart may well show us that these efforts could well be in vain. If we have a look at that chart, the A to B decline since September the 19th only seemed to be a correction, that's shown in red, within the longer term uptrend in blue, wherein the price pushed sharply off the lower border of the blue channel around 87.5 a barrel. After that short respite, it then broke through the median line of the red channel at $90.25, confidently overcame the level of $91.35, where it then started to slow down a little bit in the 10 days ago when we were sort of approaching point A. We have also exceeded the upper limit of the red channel. Now, it's going to be very important in terms of the price moving higher for the bulls to gain a strong foothold at $93. And if this rally isn't exhausted, if you like, it could well see it push higher towards the upper border of that blue channel. On the other hand, we could be looking perhaps at an overbought market, and maybe will be a desire to lock in profits before the weekend, and statements from the US government could contribute to the formation of a correction. Now, if that does happen, that may be back to the median line of that blue channel. But as I say, it certainly seems to be driving upwards. And will this correction come? Will we see an easing? I think it's fair to say the OPEC Plus countries probably don't want it to come down from where it is. We wish you luck with your trading in the week ahead. Bye for now.